Hello, everybody. This is Daniel Young, owner and founder of Adapted Perspective. I believe it's my purpose, my calling to help you identify your dreams and help you reach your version of financial freedom and maintain it so that you can pass your wealth off to the next generation. Um, it is almost July 4th. I am a day late in making this video. And before you uh, tell me anything that I could have done in order to schedule this to have it drop earlier, all of those things are true. I just let the time get away from me. So yeah, the market was open today. It's closed tomorrow, and then it's back on Wednesday. So I'm going to go ahead and film this, even though it's a day late. Um, July 4th. I hope you enjoy your July 4th, but I also hope you remember why we have July 4th. There are lots of videos you can find on YouTube that talk about July 4th and what it means overall. But we celebrate our country, and the national pride we have in our country is a good thing. It doesn't mean we're perfect. There are lots of things in our country that aren't perfect, and I'm not going to get into those here. If you've watched my videos in the past, you probably can piece some of that together. But we should celebrate our country. We should have national pride in our country. There are not many places, and I would say there's not another place like the United States in this world of ours where it promises the freedom that we promise. Pick your country, and the inherent rights we have listed in the Bill of Rights are not the automatic rights of citizens of other countries. This country was founded for specific reasons. Um, and if you don't know what those reasons are, you should read the Constitution, because that document will explain why we founded this country. And it's not going to come out and say why we founded this country. But if you understand the contents of the document and can extrapolate a little bit based on what's in it, you can look back and see why we founded this country. And the Bill of Rights are not rights given to us by the government. They're not rights given to us by any one person. They are inherently ours. And regardless of what this culture tells you and what this modern day news agency tells you, when this country was founded, it was founded by Christian, God fearing men who believed that God gave the citizens of this country, or what would be the citizens of this country, certain unalienable rights. They were bestowed by Him and were inherently ours. They were not given by any man, they were not given by any country. They are inherently ours. So if you have not read the document, and if you have not read the Bill of Rights, I encourage you to read the Constitution and read the Bill of Rights and celebrate our freedoms that are inherently ours, and celebrate the amazing freedom we have in this country. And you can argue that it has been egregiously taken and eroded away, and I would agree with that. That we have far fewer freedoms today than we had 100 years ago. And my hope, my hope is that we can get those back. The government is phenomenal at taking and very poor at giving back willingly. You got to have a insanely bold person leading that office, leading that movement in order to restore power back to the people. And we have not had that outside of one person in my lifetime. Um, so moving forward, I will continue to show what I'm offering in this closed-end fund master. Information, the consolidation of data, our funds that we own, and then how we filter out all that data. So the reminders, it's an unedited video. Who knows what you'll hear in the background as I film these in my house, which my cat is currently on the prowl, having just been fed. He's playful, so who knows what you'll hear, or maybe he'll make another appearance. I'll be going over our financial system of using closed-end funds instead of using single entity stocks. So the disclaimers. I am not a financial advisor. I am not a financial advisor. I am a financial strategist. The information contained in the video is provided on an as-is basis and does not represent personalized investment advice. Information is from sources believed reliable, but no guarantee or warranty is made as to the accuracy. I may be invested in some of the closed-end funds recommended or reviewed. The full transparency of that is we own the ones colored in blue. I assume no liability for your use of the information contained herein and encourage you to educate yourself on the market, to consult with a licensed professional, and to know your goals before investing in anything. And though I encourage you to talk with a licensed professional to get their advice, quite honestly, because I have to say that, I also encourage you to not be afraid to walk your own path. I don't speak like the herd. I walk in very limited company, and sometimes I walk alone, and I'm okay with that. So let's sort and target some closed-end funds. So to do that, I need to share a screen. So this is the master file, or the master tab, I guess you could say, for closed-end funds. And I updated this over the weekend. Full system update, new month. Generally, I update the funds that are in blue that we own. I update, I update the ones that are in purple that are recommended, and I update the ones in green that I track for different reasons. The ones that are in dark gray are shaded out based on these reasons here. The ones that are in white kind of fall in the space between. I don't track for various reasons and or just can't nix them out. So yeah, normally I update purple, blue, and green every weekend. But with a new month upon us, I went through and updated all 438 funds. And as the market has moved a little bit, which has really moved all in technology's favor, this overall yield has gone down because not many people have updated or have increased their dividends. So as the price of everything goes up and the dividend stays the same, then the yield will go down. Meaning, if you bought AGD at, like we did, we bought it at 9.3, that's the yield. If you bought it at 9.8, you'll have a lower yield because it's this dividend. So it's monthly. It's this dividend times 12 divided by the current share price of when you buy it gives you the existing yield. So we bought it at 9.3, I think. So if they change their yield to 0.08, that becomes our yield based on our buy-in price. So here's every fund, but in order to sort the funds, we're going to look at things based on the discount and then sort based on our targets. Take all of these asterisks, copy them, move them to this new tab. Current just helps me know what we have when we buy stuff. So we're going to scoot these over. Now, they're ranked by their, excuse me, ranked by discount, and then they're ranked by target. That being said, we don't want to rank them back by discount because we're not going to pay premium. So anything positive means there is no discount and they're actually selling for more than they're worth. This fund is closing. I love this fund, but this fund is liquidating, so it's not an option. There are some interesting funds that we don't have, but we're not interested in buying in anything new at this time. And if you're brand new to closed-end funds, we own some really cool funds. I mean, honestly, outside of the funds that we've earmarked for sale, which I want to say there's maybe 4 funds for different reasons, we own some pretty cool funds. even though there are a lot of other good funds out there. So yeah, we own everything in blue, not looking to add anything. Uh, DMA, God, the discount continues to grow. Um, and then if we did add anything, this one would make the list of possibilities. Uh, and I've started earmarking, say, adding notes on targets just to help me better track and understand what exactly, or kind of like a quick reference guide. Uh, so if we look at the overall discount, historically the discount is almost double. Or historically the discount's negative 13 or minus 13, but currently it's almost double of that, or I say it's more than double of that. Currently it's trending above its 5-year discount. So it's a great snag, but we're not looking to add anything. So then what are all these different asterisks? Well, the spreadsheet tells you. So triple is buy alert. It's either double the historical discount or it's finally below premium. Maybe it's double the 5-year average. 2 is a great dollar cost average buy, and 1 is we're just tracking. So in reverse, say, oh, the difference of a week. Last week, NML was a buy for us because it was below our average price, and I know that because of this page. Last week, so our overall average of everything we've bought for this one fund is this price. Last week, NML was selling for $6.30 a share, so that would have been under that. It's still priced well. Like it's still a great snag just based on the overall discount, but it's not going to make the top this week. These funds, I'm not thrilled with. There are several people who love AOD. I've not seen it. AGD, we inherited. They bought a fund we owned named DDF. Yep. And DDF, I loved. Fairly consistent dividends, good dividends, solid dividends, special dividends. But then they sold the fund. So, or their management team sold the fund. And AGD inherited a wonderfully organized portfolio, the portfolio McCann style portfolio, where it's just like I don't need to diversify because this one diversifies for me. And AGD inherited that and hasn't done anything with it, or at least hasn't done anything what I would like with it. KMF is still supposed to be bought out by its sister KYM, so it's not an option for us. NBXG is above our buy-in price. And honestly, technology is crazy high at the moment. The AI trends are really boosting the market overall. I still think we're making gains in oil and energy transfer, but it's hard to buy technology when it's already high unless it's a great dollar cost average move based on the overall discount. So NVXG, it's only been around a year. It's built for 5G technology and growth, but at the same time, it's currently lagging the general market. So Cuba, not happy with how that fund has been run. And if you want to know more, please watch my other videos. Everything with 2 asterisks is a dollar cost average move. And what we're trying to do is sort the data as best we can. There's a ton of data on this page, right? Every stock or every closed-end fund has a share price. They all have dividends. They pay different, maybe not different dividends, but they pay their dividends on different schedules. So you end up with different, even different yields based on overall price. They all have different discounts. And over here, yes, they are marked differently. So The best way we found to really sort the data and put it into perspective is to rank it by the overall discount to net asset value. So that being said, just because this one is at almost minus 33, meaning for every dollar you're putting in, you're essentially getting that stock's value for 67 cents on the dollar. This one would be almost 87 cents on the dollar. So you're getting it at a discounted price. But just because that's almost 33 doesn't mean it's any less or any greater of a deal than this, because HTY is a tech fund. The historical data, I wish this didn't happen this way. Let's see. There. So the historical data says the pricing is premium, like there is no discount, right? And the 5-year data average is about a -7. So it's almost double the 5-year average, and it's way below the historical average. So that's an amazing deal. This company's been around a while, right? Historically, the discount's near 15, so it's double the historic. The last 5 years is about 19, right? And then they've got buyback in place, so it should help the price in general. So the best way to look at this first is by discount. Then you get into what you own and don't own. If you don't own anything, um, I'll give you some advice there. But since this is all of what we own, and since I do read a ton in the market, I'm going to filter a lot out. So for us, just based on discount, um, I'm going to have to widen back out apparently. So there we go, HGLB. So it's been around 4 years. 3-year discount is pretty much the same thing it is. It's dollar cost average based on our current portfolio. Facts, historical discount around 8. It's almost double of that, but not quite. It's pretty much the same thing as its 5-year discount. IGR, commercial real estate is up and down, and there are a lot of people saying it's going to be down. That the benefit of IGR is it's diversified within the portfolio. Yes, it's all real estate, but it's US based, it's international, it's commercial, it's other. Its historical discount and its 5-year discount are about the same, and it's about the same now. So based on our buy-in, it's a great dollar cost average, but it's not as good of a deal as one of these based on how its current discount relates to its historical discounts. EOD is a category 1. Let's see. Yeah. Well structured, but they've had 5 dividend decreases in a row. That's frustrating. They're in buyback mode. Historical discount around 8, 5-year discount around 7, it's pretty much the same. Currently, pretty much the same. It's a great dollar cost average, but it's not as good of a deal as these. And then this one looks to be reformed from a prior version of the company. The reformation period is just a year old. Average discount's about 8. Pays a healthy dividend. Is based on floating rate loans that, well, as I copy what my copy the stuff that I read, so I have notes. Yeah, floating rate loans that love the aggressive Fed. With the Fed pausing, it kind of paused as well, to be honest. So let's take these off. Then we're left with this. So this is going to mirror my suggestions based on last week. So if you're brand new and you want a monthly payer, you could argue that that's this fund. It's recommended by others. For me, as a shareholder of it, I would buy it as a long-term deal if it gave me a great dollar cost average. So I have it marked as sell because as a shareholder, I'm not happy with the appearance of things. The company tends to do things on their own without shareholder input. Uh, Change the name, buyback period, tried to convert out of a closed-end fund a couple of years ago. Um, from the people I read, they love how it's managed and love how its management team structures the company to then just continue being able to put out this amazing dividend. So if I could get it for under this price, right, which it is, this keeps track of our dividends, which it is under that price, then it's a great deal. And just based on discount alone, if you're looking on just the overall amount of discount, so if we relate this to a dollar and say, um, if our break even point is a dollar, and now that's a dollar minus 32.91, so we'll just say 33, then for every, it's like, I can't, I can never say the chart, I can never say this well, which sounds weird since I produce these videos. You're getting a 33, you're getting a 33% or 33-cent discount for that dollar for every dollar you invest. So instead of the full dollar, it's more like investing 67 cents per dollar. Um, so just based on that stat alone, that's the best deal on this list. But if we look at the long-term end of things, like if we're investing for the long run, then I still think oil and energy transfer is the way to go. And for our portfolio, we have two kind of moonshot roller coaster funds that reset every 2-ish years. One is GLO, the other is ZTR. And based on where those are, based on their discounts, based on their dollar cost average, based on our portfolio, those are great buys for us right now too. These are heavy. They're heavily weighted in banking. Uh, yeah, technology and semiconductor. It's a great dollar cost average for us. FGB is private equity and business development. That's an option, but I think we have better options. HQL is um, healthcare. Um, it's all biotechnology, and it's a well-run fund, but there's better deals for us right now. FEI is. I read an article last week that uh, a group loves it based on its renewable energy components, but from my experience, of all the oil funds we own, which we currently own 5, I believe. We can go check though. So we own oil and energy transfer. So 1, 2, 3, 4, because they haven't merged yet. 5. Yeah, we own 5. Of all of them, this one has not raised its dividend back to COVID level or has not raised its dividend since COVID. So is it due for a dividend increase? Yes, but it's been due for a dividend increase for a while. So you can see everything drop off. They've paid a consistent dividend, but they haven't changed the dividend either. And every other fund we own has changed or say increased their dividend at least once since COVID. So if what I would pick, if you're brand new and you want a monthly pair with a portfolio and a can, that's CTR. But if you're playing it just based on the overall discount and you're not looking at anything else with any other type of perspective, that's HFRO, which is technology and data center and cloud management. But for where I would put my money, oil and energy transfer, I don't know why that's 1%. Let's see, format, number. Can I clear formatting? Plain text. Why is this the weirdest things? Still 1%. That is hilarious. Let's see if we can do it this way. Every single spreadsheet I make, like I copy the one before, I just duplicate it. So it would be this same exact number formatting system. This same exact number formatting system. And yet every new spreadsheet I make, something else changes in the spreadsheet. So where I would put our money, and I say that because we own this company. Does it pay a great yield? Yes. Has it paid a consistent dividend? Yes. Is it a great deal based on the overall price? Yes, but so are all four of these for our portfolio. Um, it's a pretty it's it's di it's diverse within its sector, but if you want something that invests in everything, that's this fund. Um, and for a long-term purpose or even short-term, like KYN, we could hold well past our lifetime. GLO and ZTR, they seem to turn over as they cycle through every 2-ish years. So pending your strategy, you can buy low, collect all the dividends, sell high, reinvest it in something else, wait till it drops back down, buy low, wait, right? So buy low, sell high, buy low, sell high. Or you can buy low, collect the dividend all the while, right? Wait for it to come up. And then the same thing, buy low again, right? Wait for it to come up, buy low again, wait for it to come up, and then you dollar cost average your lows, keep it during the high, dollar cost average the low, keep it during the high, so you keep the dividend paying regardless, right? And you're just buying more based on its average pricing. If you're selling it, our portfolio is not structured based on the typical buy and hold methodology. And as I scroll through these, so you have lifetime, sell at certain gains, lifetime, long term, meaning kind of indefinitely. These are marked for sale at different numbers. That was going to be the sell point, but they're going to sell this company long before it reaches here. So our portfolio is not exactly based on the general buy and hold. There are some funds that are earmarked that way, but it's not the whole thing. So my current thought process on these two is that it's a buy low, sell high, reinvest the money, right? And you're kind of using that to, says you buy low and sell high, you're swinging from one into the next one. So what I would do if it were me, which I'll be honest that we're not buying stocks tomorrow. Well, it's Independence Day, but we're not buying stocks at market open on Wednesday. But if this was my money or our money, we would either go oil or these two. And let's say I had enough money to buy that much of KYN at one time. Let's see. So KYN, this is where knowing what you have is important. Currently, We own this. So if I bought 100 shares, right? If I had that much money to buy 100 shares, then I could also do this. And what I like about Google Sheets is this. So we know that 100 times that equals that number, okay? But it'll also add cells for you. So if I'm comparing, so I could buy 100 shares of KYN for that amount of money, or I could fill in the gaps of our portfolio, right? Buy a little of these two for under the same, for near the same cost, under the same cost. And what you're looking at is by period. So this pays you every 3 months, and these pay you monthly. So it's like, well, that, um, and they all have outstanding yields. Um, so I could buy this, right, 100 shares of this and get that much dividend a year, or I could do it the other way and get a slightly larger dividend for the year. But it comes down to purpose, and it comes down to overall uh, your overall goal and perspective. We could buy this cheap, right? Hold it indefinitely and get this insanely great dividend all the while. And if they do end up merging with KMF, they're supposed to raise the dividend, which won't raise it that much, but it will raise it that much over time. Okay, or we can pick these up at low prices. I don't have to buy anything else. My goal has been to kind of get everything to 200 and then really, so everything earmarked for sale at 20%, get to 100. Everything uh, earmarked for longer term holds to get to about 200 shares, and then work on boosting those lifetimes higher and higher. I mean, I could, accomplish boosting both of those to 200 and leave them there, and then come back and work on others as needed. But it's also just the overall deal. Um, that's the best deal if you look at discount alone. I think that's the better deal if you look at just lifetime. Oil, whether you like it or not, is here to stay. And then if you're looking at it at like a 2-year turnover, those are your better bets just based on the current pattern of things. So of where we would stick our money, as tempting as it is to add these two, gosh, as tempting as it is, it's that I'm OCD in ways where I really like to have stuff done certain ways. It's really tempting to round these out to 200, catch them both at an insanely low price and amazing overall discount, and just leave them there and let them take off. That's a very, not conflicting. It's just a very warring, I guess you could say, argument against snagging 100 shares of this other company. I love these three companies. I'm not an outright fan of this one. They pay a consistent dividend. They've paid this consistent dividend. They pay a great yield, which it's based on that dividend. It is the cheapest. If you look solely at dividend, it's the cheapest buy on the list. But I'm not thrilled with how management has run things. So there's the conflict there. Let's see. Those are, there we go. You see my notes for a little bit. Those are my top selections for the week. I mean, HFRO makes the list, but just based on overall discount. But this week, like last week, it's still KYN, GLO, and ZTR. So if you like the content, consider subscribing to my channel. And then also head over to Facebook and join my group there called Navigate Your Finances. The link will be in the description. As you face the week, I mean, whether you use this system or any system, As you work your way from where you are to where you want to be, you've got to remember that you are the captain of your ship. You have the power to change your life and your financial future. Many people will offer to help you, but only you can make the choice to do it. And I say that because it's important. I say that also because I started making videos based on all these financial memes, and I've seen a lot more financial memes on Facebook that are just, well, they're not great memes, and it's everybody's got an idea on how to help you make millions of dollars, but they're not all great. So a lot of people, many people will offer to help you, but only you can make the choice to do it. So choose wisely. Make it happen. Shock your world. This is Daniel Young signing off. I will see y'all on another video. Bye-bye.